Advanced Financial Modeling, Topic 11, Cost of Capital and Real Options. Learning Objective number 5, we're going to compute WACC used for project NPVs or used as IRR hurdle rates. So as a summary, a company's current WACC is the appropriate NPV discount rate and IRR hurdle rate for investments as long as that new investment has the same business risk or beta as the current firm, and 2, the investment has the same financial risk as the current firm. So let's break these apart separately. Number 1, if Walmart wants to open another store, a discount retail store in America, you could argue that it has the same business risk or beta as the existing company. But what if Walmart wants to open a bank in every store? Well, you can think that maybe banking has a different beta, correlations and to the market. So you would think that would naturally have a different beta, and it will. So number 1, if you're in the same business, you're probably going to have the same beta. The second is if the new venture is going to have different levels of DDE, then that's going to be more or less risky. So that's also going to affect their beta. So you only use the firm's current WACC as we've calculated for Walmart if the new investment has the same business risk, in other words, it's the same industry, and the same financial risk, in other words, has the same DDE ratio. If not, you need to adjust the beta and the discount and the DDE ratio for each project. So let's look at the WACC formula. I said that the WACC is equal to the equity percent times cost of equity plus debt percent times after-tax cost of debt. And we've learned that cost of equity based on CAPM is the risk-free rate plus the levered beta times the market risk premium. The levered beta is the unlevered beta times 1 plus the DDE ratio. Remember, E percent is E over D plus C, and D percent is D over D plus C. So, putting all this together, remember the WACC is the equity percent times the CAPM cost of equity. That's going to be the risk-free rate plus the unlevered beta, using an industry beta, times 1 plus the D to E ratio times the market risk premium, plus the debt percent times the after-tax cost of debt. So let's put all that together for Walmart like we did in the last section. Walmart had an equity percent of 83%. Here's the risk-free rate of 1.95%, the unlevered industry beta of 0.515 times 1 plus their DDE ratio of 0.194 times the market risk premium of 6%, plus the debt percent of 16% times the after-tax cost of debt, and we got a WACC of 5.19 for Walmart. Now that 5.19 we will use all day to evaluate different investments for Walmart in the same industry. In other words, food and discount retail with the same leverage. However, if they want to have ventures outside their business lines with different DDE ratios or outside the country, we're going to adjust this formula accordingly. So here's the first example. What's the WACC for an investment for Walmart and another store? So it's going to be the same business risk, but higher DDE ratios. They want to finance the new store with more debt. All right, so again, our formula is here for Walmart's WACC. Here's the general formula here. If you're going to use more debt percent, what's going to happen? Well, the debt percent is going to go up. You're probably going to borrow at a higher rate. KD is going to go up. That DDE ratio is going to go up, which is going to cause the levered beta to go up, but the equity percent is going to go down. It's not really clear what's going to happen to the WACC because of all the moving parts. Remember, this is the beta for the base case Walmart. Their current WACC was 5.19. But what if we say that the DDE ratio for this new store is going to be 0.5? Which presumably is different than the current DDE ratio. Well, if that's the case, we need to put through that new debt percent through our formula. One really big hint. I've mentioned this before. D to E ratio is not equal to the D over D plus E ratio. I call that the debt percent ratio. These are not the same thing. D to E is not the same as debt percent. but you can convert from DDE to D over D plus E easily. DDE over 1 plus the DDE ratio mathematically is the same as the debt over debt plus equity ratio. So you can use that trick all the time. DDE over 1 plus DDE is equal to the debt percent ratio. And that's what I did here. If the DDE ratio is 0.5, 1 plus the DDE ratio, the DDE ratio over 1 plus the DDE ratio, 0.5 over 1.5 is 0.67. So this is the new debt percent ratio that we're going to use. We're not going to use this one here, 16%. We're going to use 0.67. That means the equity ratio is 1 minus that. So that's what I'm going to use for this. Let me erase all my scribbling here for a second. So what would be the WACC for this new store? Well, I'm going to put in the new equity percent ratio, the new debt percent ratio. When I lever the beta, I'm going to multiply times the new DDE ratio, 0.5, and not that 0.194. And we'd have to be given this, but we'll presume that since it's going to be riskier, the bondholders will demand 4%, not 387. And for some reason, there's a slightly different tax rate, 22%. All that would have to be given as far as the new cost of debt, and the tax rate would have to be given as well as the new DD ratio. And in that case, you get 543. That's the discount rate for Walmart to open another store, same business risk, but using a DDE ratio of 0.5. What if they want to open a new store in India? A new superstore in India, same business risk, same DDE ratio, but it's going to be in India. Well, there's one trick that sometimes we use as a shortcut to handle country risk. Presumably, doing business in India is different than doing business in the US, might be higher or lower risk. So what we use is something called a sovereign risk premium. We look at the long-term yields of Indian debt versus long-term yields of US Treasury debt and compare them. And what if we looked that up and we found that in India, their sovereign bonds have a yield of 2.55% higher than US. We'll call that the sovereign risk premium. The government's risk premium of India versus the US. If that's the case, what we would do as a shortcut to try to handle the risk, if we assume that's a proxy for the risk of doing business in India, when I calculate my KE here, I'm just going to add 2.5%, 2.55%. And in my KD, before I multiply times 1 minus the tax rate, before I multiply 1 times 1 minus the tax rate, I add 2.55% also. Now, sometimes you'll see some people just add 2.55% to the WACC. That's kind of a shortcut some people use. But this, I believe, is the more common way and the theoretically better way, because the idea is if we should demand, shareholders and bondholders should demand an extra 2.55% for an investment in India. We're going to add that to KE, but when the bondholders demand an extra 2.55%, we don't pay it all because we get a tax shield because interest is tax deductible. So it's a little bit less than adding 2.55 to the WACC, because when we apply the 2.55 to KD, we get a tax shield. So in this case, we would use 7.64% as the WACC or discount rate for opening a store in India for Walmart. What if Walmart wants to put a bank in every store and it's going to have a new DD ratio? So now it's a new industry. There's no reason to believe that banking would have the same beta as groceries and discount retail. So what we're going to do is I'm going to go to DeModern's website and I'm going to look up the banking unlevered beta, and I'll plug that in. I'll plug in the DDE ratio of the new investment, the cost of debt of the new investment, the tax rate of the new investment, the debt percent of the new investment. And if you go to the spreadsheet, you can see the numbers actually used, and it turned out to be a 4.62% WACC, mainly because the betas of banking are a little bit lower. All right, so if you're going to have an investment in a new industry, you need to use the beta of that new industry, because the current firm's WACC reflects the risk of doing business in their current business line. Now, here's an interesting one. What WACC do we use if we want to say install solar panels at headquarters? You have a proposal that they want to put solar panels at headquarters, and it's going to save electricity. And so someone proposes during a capital budgeting process that they need $100 million or something, or $10 million to do that. Well, one could argue that solar power savings have no business risk. There's zero beta, since the costs and savings will not go up and down with the stock market. Remember where beta comes from. Beta is a regression of the returns of the stock versus the market. If I install solar panels, I'm going to get maybe a pretty certain savings in energy, which are not going to go up and down with the stock market. So you can assume, or I guess safely assume, that the beta is zero. So you could say it has a risk. You should be just discounting at a risk-free rate, because CAPM says the risk-free rate plus beta times market risk premium, and if the beta is zero. However, firms often approximate their risk-free rate by using their after-tax cost of debt. So they might say, well, for the solar panels, we just need a 2.9% return. So in theory, what you could do is finance all of that with debt, since it's risk-free, and you just need to clear that 2.9%, which is their after-tax cost of debt. But I will suggest this is actually quite controversial, because some people argue, well, what is a Walmart? It's a physical location, it's cash registers, it's heating, it's cooling, it's lighting. So how could I separate any piece of that, including solar panels, and say this part of the store has zero business risk? So in this case, some people will just use the business WACC, and some people will use the after-tax cost of debt, how you want to consider the risk of this investment. So this summarizes all the different variations of WACC you would use for an NPV discount rate or an IRR hurdle rate. If you think that the project has no risk, you just use the after-tax cost of debt. I'm going to tell you 90% of the time, investments in a firm are in the same industry. It's Walmart opening another store, and there's no discussion of changing the DD ratio so that they have the same financial risk. So 90% of the time, you're going to wind up using the firm's current WACC. That's going to be the default. However, if there's a discussion, we're going to open another store with a different DD ratio, well, you're just going to relever the betas and use the new DD ratio. If you're going to be in another industry, but you have the same financial risk, just use the new proxy beta. When I say proxy beta, it's just the industry beta for that new industry. So if Walmart wants to open a bank, it could just use M&T's bank beta or an industry beta. If Walmart wants to open up a coffee store, it could use Starbucks beta or an industry specialty food beta. And if they're going to be in a different industry and a different DD ratio, then you just do everything. You need a new beta, you need new DD ratios, you probably need new cost of debt and everything. And if you're going to do a business outside the country, one shortcut is just add a sovereign risk premium, the KD and KE separately. So this is a summary of how to get a discount rate or an IRR hurdle rate for projects or for investments the firms are considering during the capital budgeting process. Last thing, how do I compute the WACC of a private or a small firm? Well, private and small firms often don't have a lot of the parameters that you would need for this process, this calculation of WACC. Especially private firms wouldn't have a stock beta. So what are you going to do? Use an industry beta. So if I want to try to value a local grocery store that's private, and I'm thinking about buying it, and I need to discount forecasted FCFS at some WACC, I will just maybe use Walmart's beta or use the industry beta. Now, what about DD ratio? If the firm hasn't even started yet, maybe they're so young, all they have is a little bit of private equity funding, but you're trying to value the firm out through 50 years or 20 years. Well, sometimes you just use the industry DDE ratio and say, well, eventually when this firm is mature, firms in the same industry tend to kind of huddle or gather at the same DDE ratios. So that's one solution. Sometimes these firms don't even have a cost of debt. Well, what do you use? Well, you might want to use the cost of debt of a firm with similar DD ratios. Or if they do have a rating, like an S&P rating, use that. Lastly, small firms, discount rates, WACCs, usually, when we talk about for valuations, will often use a small stock premium or a small cap premium. Theoretically, we think that, or in practice, we find that small firms seem to be riskier than large firms. They have a higher rate of return than what would be predicted using the CAPM model. So presumably they have higher risk. So how do I account for that? And you can just think of that. It must be riskier to open up an independent grocery retail store in your local town than Walmart opening up. And maybe it's related to brands. So it seems like it would be riskier to open up a retail grocery store independent. So what we might add is say 2 to 4% to the WACC and call that a small firm risk premium. All right, so in this topic, we computed WACC to use for project NPVs and our hurdle rates.